Click. I am going to turn it over to Jeff for introductions.
Okay, thank you, Philip. Good afternoon, everybody. Thank you for attending today's webinar. I really appreciate the opportunity. As Philip mentioned, my name is Jeff Cunningham. Also presenting today is Tim Anderson. I'm a partner in Reuben Brown's Real Estate Group, and I lead our Denver real estate team. I've been working with clients in the LIHTC affordable housing industry for over 22 years and have been with Reuben Brown in the Denver office since 2013. Tim Anderson is a tax partner and chief operating officer of Reuben Brown's Real Estate Group. Tim leads Reuben Brown's real estate tax practice, and as chief operating officer of the real estate group is responsible for its overall operations. Tim has participated on numerous panels discussing topics such as opportunity zones and changes to investment tax credits in the Inflation Reduction Act, which we're going to be talking about today. A little bit about Reuben Brown. Reuben Brown is the 36th largest firm in the country in the most recent rankings, which is up from the previous ranking of 39th. We are a full-service public accounting firm, and we have over 120 team members in our Denver office and over 900 team members total in our Denver, Las Vegas, Nashville, Chicago, Kansas City, and St. Louis offices. Our real estate group is our largest industry group, focusing basically anything with a tax credit or with a HUD component to it, and is one of our national practices. And we serve clients in nearly all 50 states and the U.S. territories. In today's webinar, we will focus on changes made to the solar and 45L tax credits in the Inflation Reduction Act. The Inflation Reduction Act was signed in August 2022. In the past 16 months, regulation guides from the IRS has pretty much trickled out. But today we'll discuss the guidance and what items the IRS still needs to issue its guidance. And as Philip mentioned, as we go through today's webinar, please jump into the Q&A and ask questions, because we're going to be jumping around to different topics. We want to make sure that your question is on point with the topic that we're currently discussing. So, Tim, you want to go ahead and start?
Sure. Thank you. Thank you so much, Philip. Thank you, Jeff, for the introduction. Definitely super excited to talk about this topic. While I'm starting, let me do the share stuff and we'll get this going. As Philip mentioned, definitely we're going to touch on a lot of different topics from Section 48, solar investment tax credits, to the 45L renewable, like the renewable credits, and then kind of talking about other kind of interplays with low-income housing tax credits, affordable housing, etc. So questions in the meantime, as you think I'm about to move on to a topic and you want to linger for a second, definitely can do that. I don't anticipate time being an issue in finishing on time, so that means that we should definitely be able to hit on some good questions that people want to know about. This is a topic that's near and dear to my heart. So my main practice area is similar to Jeff, is affordable housing and LIHTC specifically. But also work heavily in historic tax credits. And then in the past 5+ years or so, I've really been working super closely with a lot of solar developers and investors, investment funds, and syndicators on that side, who are developing solar farms and selling energy. So I've kind of got to see a lot of the solar stuff before all the IRA came out. But obviously when the IRA dropped, as Jeff mentioned, in 2022, really, it was natural for us to jump all over it and figure out what's going on. So we are also, so we're a full service firm, but we're also our in-firm experts on this, and do internal trainings, as well as, speak to multiple different clients in different industries and see how they can combine solar credits with their projects. But today we're definitely talking affordable housing and some of the new things to be aware of for 45L and the solar tax credits. So, and as I do this presentation, I've had a version of this conversation countless times, educating people inside of our group, outside, anyone who wants to know. And usually it's easier, more interactive where we're on a phone call. But sorry for clicking. Why is it doing that? So whereas I normally kind of start somewhere in the middle and do a roundabout circle, I'm going to try to start at the beginning, and we're going to slow burn this as a build up. So where we're going to start is kind of an introduction of what is the solar tax credit in 45L, some of the tax benefits and stuff like that, and then we're going to start diving into the IRA and the new changes that it brought about. All throughout in there, I'm going to offer commentary over how it's kind of interplays with the Section 42 low-income housing tax credit, and kind of where the opportunities are, and where we're seeing activity going on. Let me do that real quick. Okay, so first is just an introduction on about the IRA. So it was a law that was signed in August of 2022, and it really was trying to promote economic development in terms of solar energy, as well as some social justice via wage and apprenticeship requirements, and also trying to promote domestic content, which I will offer some commentary on the domestic content stuff later as we get more into the details. It did more than just extend the Section 48 solar credit. So the solar credit has been around in some form for quite a while, and it's been one of those credits that has historically been at the 30% range. And we were just in the middle of a phase down where we were going down to 26 and 22%, and COVID did offer a little bit of a delay in that. So normally we had been seeing lots of different patches where the 30% credit, as it was phasing down, it would get re-bumped up back to the 30% level. But the IRA did really a lot more than that. So that's why this word modify is really important. It really did modify the credit in a number of ways, which allows us to have a wonderful conversation today. So just kind of a couple highlights over what the IRA was trying to, or how it's bringing some of these modifications is they're offering different boosts. So one is a domestic content boost, which will go into more depth. This is just a highlight. They're also doing different 10% boost for certain geographic areas, which will go also kind of lay out what those areas are. And then I'm sure a lot of people on this call have heard about the 20% boost for projects that are in low-income communities, or with that are qualified affordable housing projects. So we'll definitely kind of go into each of these. Kind of just, we're not going to spend really any time on it, but they did also do some work at the individual level in terms of the energy efficient home improvement credit. So it's kind of there for some personal reading if interested. But at the business level, the IRA extended and expanded the Section 48 credit, the 45L, and the 179D deduction. I don't have a slide on 179D, particularly because it doesn't pair well with affordable housing. So I don't have a slide on it, but if I forget to talk about it, definitely ping me and we can talk about why we haven't seen so much activity, or when it may be a possible good thing to look into. So as a tax accountant, I guess we love to talk about code section this and this. So I'm gonna try to keep the the numbers as far out of this as possible. But it's kind of hard to talk about credits without talking about this code section that relates to it, because it gets kind of hard to differentiate between all the different verbiage of the different credit programs. So bottom line, where we're starting is, well, what basically is a tax credit? All of these credits we're going to talk about, which is the 48, 45L, and the 42 low-income housing tax credit. They're all a version of a tax credit, which allows a taxpayer at some level who's claiming the taxes, who's incurring the taxes, to take the tax credit and offset their tax liability dollar for dollar. So it's more beneficial than what you would think of as a deduction. Instead of reducing your income, it is a tax credit that you can apply and alleviate tax dollar for dollar. There are lots of rules related to these, particularly how the calculation goes into actually filing them and claiming them, and how it works. We'll dip our toes in it a little bit, but we won't spend too much time here. There is a carry forward that is allowable. So if it's not able to be claimed in a particular year, the general business tax credit carry forward is 20 years forward. And then there is a carryback allowable. That's a 1-year carryback. And it says FIFO. That's just another way of saying that whichever credit is earned first in a year. So if you have credits over 2018, 2019, 2020, you use the older ones first to alleviate carry forward issues. So credits can not be claimed for some particular items, which would be for property that's used mainly outside of the United States, not counting some of the possessions like Virgin Islands and Puerto Rico, used by a governmental unit or foreign person, used under a lease term with less than 6 months. And then there's some interplay with 179, which is not something we see in the affordable housing industry. So we won't linger here too much. So this first point is something that you can read, and I've read it like 8 times and my head still spins as a tax accountant. It's really just kind of the technical definition on how much is available. Bottom line is there's a very complex form and calculation in determining how credits are claimed. It's each credit has kind of its own rules and what it can or can't be used for, but we'll touch a little bit on some of that. But a lot of this is not as important on the development side, where we're looking to credits. Really, that's being fleshed out by the investor and ultimate end user of the credits on how can I use the credits? Is it worth it to me? Do I want to pay for these credits? So this is a little highlight too that we might bump back and forth to if we got a couple questions on it. Whenever there's not whenever, but oftentimes when we're talking tax credits, there is very often a recapture period that relates to it, what we would call a certain compliance period. So for our normal low-income housing tax credits, we're used to a 15-year recapture period. Whereas, if something goes wrong or the program isn't followed within the time period, there's various recapture rules and how to pay back, credits / interest, and in which situation that applies. And obviously on Section 42 recapture, we could spend a full 2 hours talking about how that works. So we are not... that is not the topic of today, but there is recapture related to the Section 48 solar panel credits. And it is a 5-year compliance period. If anyone on the call is familiar with any historic tax credits, it follows the same kind of recapture rules mostly as the historic credit. They are both considered investment tax credits, and they're filed on the same form and have a lot of the same rules. But for solar, it is a 5-year compliance period to avoid recapturing the credits, which means that the panels have to be installed for 5 years. The owner who is claiming the credits has to continue to own the property for 5 years. So any sales of the property would trigger recapture, and also the owners of the entity need to remain the same owners of the entity for 5 years. And the recapture does have a fall off for it, which is the chart's trying to get at is every year, the recapture amount decreases by 20% until you reach 0. If they've been installed for 1 year and there's a recapture event, it's an 80% recapture, and then 60% and so on. So we are also used to Section 42 low-income housing tax credits. It has a lot of very favorable rules. And the IRS and our government, federal government, uses tax credits to drive policy in a lot of ways. So they want to make these tax credits, they want to incentivize using these, as part of like a social, a way to drive these, to drive people to use credits that they think would be beneficial socially, and kind of as what the government would like to do. The solar credits also have a lot of favorable rules. And one of those rules is the recapture is actually only limited to 50% of the tax credit. So right off the bat, once you install it, 50% is not recapturable going through as you go through the recapture period. So that is a very favorable rule.
Tim, I'm going to interrupt you for just a second, and you can tell me if this is something that is better addressed later on in your presentation, but we do have a question. Don asks or tells us that one of the things that I see missing is the need to upgrade panels to 200 or even 400 amps for existing homes. Anyone talking about a credit for that?
Yeah, so not that I am aware of, and yeah, so I not something that I am an expert to touch on in this panel, but
Okay.
it's a good question.
And I have a question from Shayna. Due to the recapture rules around the energy credits, these credits would not be a good option for affordable home ownership projects under a land trust model? Question mark.
So any kind of structure where there's either going to be ownership change or sale of the actual underlying solar property or outside of the partnership would trigger recapture. Basically the entity that's installing or constructing the equipment needs to be an owner for 5 years. So any sort of if that's the property is transferring outside, then that would trigger recapture.
Thank you, Tim.
Perfect. So this is also kind of another tax rule. So most times when you get tax credits, you have to give something up to get those tax credits. And a lot of times what you're trading is a tax credit, and then you're not getting a deduction instead. So affordable housing, LIHTC, does not have any of those rules. So essentially you're able to double dip on both the actual tax credit and depreciation expense. So for affordable housing projects and developments, when you get a tax credit based on eligible basis and eligible costs that were used to construct the affordable housing project, and then that amount is what you apply the tax credit percentage to come up with the tax credits. But for those costs that were incurred and paid for, through the sources of equity and loans, etc., the partnership entity or the entity owning the real estate is entitled to a depreciation deduction. So they're allowed to claim that depreciation deduction, allocate it to its owners, and also to claim a tax credit and allocate it to its owners. And so you're essentially double dipping. You're getting both a deduction, you're getting some sort of basis for the costs that it cost to build the project, and you're getting a tax credit. That is a very, very favorable rule. So when it comes to the solar tax credit projects, you're not able to fully double dip. And what that means is, so it's similar concept. So the amount of money that it took to construct the solar panel, including the hookups, the foundation, the labor, the taxes, etc. Those costs of that contract that are eligible for the credit. Then you apply the eligible tax credit percentage, which we'll go through tables later, and then it determines a tax credit. The solar tax credit is claimed all in the first year, once the installation is online and placed in service. And you claim that full tax credit based on the percentage. So the rule is that whatever your tax credit dollar you're getting, you take half of that, and you have to take less depreciation. So we can do like a rudimentary, people need numbers to follow along. Let's assume that you have a solar panel that costs $100,000. That's eligible for a 30% tax credit. So once that installation is in service, that would be a $30,000 tax credit. So you're able to claim and pass to its owners a 30% tax credit, or sorry, $30,000 tax credit. And you're eligible to take depreciation on $100,000 less half of the credit. So less 30 divided by 2, which is 15,000. So you're able to claim depreciation on $85,000 of the solar installation. And solar is a 5 years tax depreciation class, but is eligible for bonus depreciation. So also try to remember to kind of talk about what we see in some deal structuring stuff. So you're able to still take some depreciation and double dip a little bit, but you're trading some tax credit. You're basically getting $30,000 of credit and losing $15,000 of deductions. But the math turns out that you're going to take those tax credits pretty much any day of the week. It's still very, very beneficial. And it's hard for me to automatically assume, but really all these deals we see in affordable housing and LIHTC and et cetera are really structured as partnerships, as like flow through entities. So everything in the way that we think about it is being passed through to owners, since partnerships typically aren't tax paying entities. If not going to dive too much into this either, but just this is definitely a rule that's something to think about. Sorry about that. That the basis reduction is not only of the property, but it is also in the equity interest into the partnership. So the partners do have an equity reduction there.
I'm going to interrupt you again, Tim. So going back to that question about the land trust model and the credits being used for the original owner, Don asks, so could you peel out the solar as a separate ownership that does not pass on the homeowner, onto the homeowner until the developer has realized those tax credits? That way no recapture takes place.
Yeah, I mean, if the solar, you can split up the ownership of assets, however in lots of different ways. So yeah, you can have a separate entity own own the solar property, and then after the compliance period, you're free to do whatever you want with that. And it's, it's not dissimilar to what we see in what I was mentioning with like the solar developers that I work with, and kind of like the solar models, that the entire assets in those partnerships is typically solar assets. And they either sell the installations or, do or hold on to them and sell energy for 5 years. So yeah, so that can be an option. And it's not dissimilar in an affordable housing project to separating out commercial into another into another LLC type entity.
Thanks, Tim.
Awesome. So we probably touched on some of these items already, because this is really, we're still talking about solar tax credits, which is under Section 48 still. So the IRA did extend the ability to use the credits. There are lots of different types of credits. So again, when we're thinking affordable housing, the number one thing we think about is solar panel, solar energy. But there's also other types of renewable energy that are allowable as credits, namely solar, wind, geothermal, and some hydropower stuff. Which is, not typical, or it's definitely not typical for an affordable housing project, but there are other types of credits. And that'll be useful when we start talking about some of these transferability rules later, and what credits are allowed for different things. I'm still amazed I keep some of the stuff straight in my head, but it's definitely a lot. It's definitely tricky to keep on top of. So when we talk about IRA and the solar credits, I kind of do a look at what's the old rules and what are the new rules, and kind of when are these rules effective. So prior to projects, prior to the IRA, like I mentioned, it was a 30% tax credit for solar, and it was in the middle of a phase down to 26 and 22%. But now going forward, it seems like not favorable, but they actually set the baseline down to 6%. It's like, wait, well, hold on a minute. So the baseline is now 6% as kind of the general rule. And now there's different ways to start your credit at a 30% mark. And it's important to note that this is kind of an or type thing. It's not an and thing. So the first thing right off the bat that I would point out is that if your energy output of the solar installations in an entity that are claiming the solar tax credits is less than 1 megawatt, then you start at the 30% rather than the 6% credit line. And for affordable housing and residential projects, really 1 megawatt is, they're typically very much less than one megawatt. The only time I would even get close to that, if you start looking at maybe, very large parking lot, carport type situation. But any type of your typical rooftop installation is pretty much going to be under 1 megawatt. But definitely something to think about, because as soon as you tip over 1 megawatt and you try to claim credits, you're going back down to the 6% mark, unless you can then meet the prevailing wage and apprenticeship requirements, which means that the labor and construction and stuff related to the solar panels would have to meet specific wage requirements, and that would be at the solar contractor level. So again, not necessarily a deal breaker, especially when we're looking at affordable housing and regulated residential real estate, where a lot of either programs or areas do require these prevailing wage requirements anyway. And it's, I guess it's a good time for a little aside. So working in a full service CPA firm is kind of funny sometimes. So we actually have some engineers on staff who are very well versed in R&E, research and experimentation credits, and also, they do. One of them is a certified 179D 45L person from the IRS. And so when the IRA came out, I've been in various talks with them and kind of bouncing ideas back and forth. And he was very, very concerned and saying, well, no one's gonna do, these 45L or this, they're gonna meet this prevailing wage requirements. And I was like, I don't think you understand our industry. Like, we're used to navigating all sorts of regulations and rules and already are dealing with prevailing wage and apprenticeship requirements in multiple areas. So definitely, I think he was very surprised, like, oh, so we are going to see, this is going to be a big deal. And it's, and I'll kind of talk some numbers in a bit, but this has been a very huge deal and very, very impactful so far. So that's just a little aside on the prevailing wage part. So basically, so for 2023 going forward, we're looking at these new rules. And then if you would go back and amend or try to claim, credits that were missed, then you have to know which period you're looking at, because the old rules are still in play prior to 2023. So there are a couple of boosts. We've kind of already talked about them, but good to kind of just keep digging into these until till we can kind of address maybe some of the questions or try to understand them a little bit more fully. So for the first boost is what is called the domestic content requirement or domestic context boost. So, and it would be and we kind of are throwing this in what we call like a 10% boost bucket, which that would turn the tax credit from a 30% of your cost to a 40% tax credit of the installation cost, which is a huge, it's not just 10% of 30, it's a full, extra 10% tax credit. I'm not, and there's lines in here talking about if you're at the 6% requirement. I'm assuming all of our deals, that we're talking about going forward are less than 1 megawatt and are at the 30%. So it's really a 10% boost. So this sounds really cool and like, oh yeah, this is great. This is being easy, 10%. Except I actually don't know of any current deals or buildings being completed that are actually meeting this requirement. I kind of was doing some looking. It looks like currently 75% of solar panel manufacture is done in China and other overseas locations. So meeting domestic content is very, very tricky, especially when we look at, we have a slide later on what is domestic content and what is those requirements. It's very, very tricky. Previously, I mentioned that there's some geographic boosts. One of these is what's been termed this energy community, which so that was kind of vague in the initial IRA, but in subsequent guidance from the IRS, they kind of sent out some definitions and further guidance. So we know what an energy community is. It's a couple of different ideas. It's either a brownfield site, which would be, involved in environmental remediation, or there's an area with unemployment rates at or above the national average, for the previous year, where fossil fuels, contributed to employment. And then also there's a census tract, and I believe there's mapping tools online to determine whether you're in a census tract or in a directly adjoining tract where coal mines or coal-fired electricity generating units have been closed. So obviously for these energy communities, besides the brownfield site, the mapping tool is going to be, largely centered around communities with, energy production is kind of like the older, quote unquote, less clean, options for energy in the past. So trying to incentivize, these areas moving into new solar and other technologies. So this this calculation shows I guess the holy grail of all calculations for tax credits, which would start at the 30% boost plus the domestic content plus energy community, plus a qualified low income residential building. So, so yeah, the last boost is this 20% one. So a qualified low income residential building is satisfied by a Section 42 low income housing tax credit project, does qualify as a qualified low income residential building. In order to, so all these other ones don't involve an application process, but this 20% boost for the qualified low income residential building does involve an application process through the Department of Energy. And same thing with the low income economic benefit project, which I believe there's also mapping tools available because that's more based on census tract, whereas and that low income community is not dissimilar to like a new market tax credit idea of a qualified low income community, which would be, certain levels of area median incomes. So with the 20% boost, the IRS earlier this fall released some guidance and also launched their application. And they initially started with a 30-day window that expired, I believe, on November the 18th, where they said that if you submit your application in this first 30-day window, then we will, deem as if you made your application on the first day. So look at all those applications first, and then post the 30-day window, which we're now in. Any further subsequent applications will be reviewed at, in order as they are submitted. So there is part of the IRA, there was a specific, I guess, quote unquote, allocation of solar energy kind of output that was allowable for the DOE and IRS to award these boosts for. But it was a very, very a large allotment. So I'm not sure, they haven't released numbers that I've seen on how much they've divvied out yet or approved. But I did see that 46,000 applications were submitted in the first 30 days that the site was live. So I thought this was going to be big, but 46,000 across the country kind of blows my mind a little bit. So I think when it first came out, the DOE was expecting about 100,000 applications annually. So there's a lot of activity going on in this area. So a couple of little asterisks on little further definitions. Domestic content is defined as 40% prior to 2025, and then it increases 5 years afterwards up to 55%. So that would mean that 40% of the components that are involved in the manufacture of the solar panels would be domestic, as in U.S. manufacture. So it's I love the idea of this, and it's it makes sense. So also what they're trying to spur is homebound or U.S. manufacture of solar panels. The only problem is it's like a very hard hurdle to meet instantaneously of dropping the guidance and saying, okay, now if you turn around and manufacture solar, then you can help other can be qualified for a 10% boost. So I'm certain this will still drive that. I'm sure this is going to hopefully evolve as we go further. And I know there's also kind of push in the industry. I've seen some papers being written trying to lower the requirements a little bit, saying 40% is too high, but we will see and provide, I guess, have to provide updates if stuff changes. So also when we're talking the solar tax credits, I mentioned I really like to talk old solar tax credits pre-2023 and what we're kind of living in this 2023 going forward environment with the Inflation Reduction Act rules. So previously, the solar tax credits were still being, we still saw them a lot in affordable housing projects, and we're still providing a lot of useful benefits, and they were useful to investors, and the pricing was good, and they were, providing additional sources to the project to construct the affordable housing project. But there was a downside previously. And we kind of already talked the one downside, which was you had to take less depreciation. If you're taking the solar tax credit, you couldn't double dip on all of it. You could only get 85% of your depreciation. So I guess bad news is that rule is still in effect, but there was also another rule. So as we, as when we start doing these tax credit, these tax credit structures, we love to combine in creative ways, like different types of credits and incentives, and seeing how we can maximize, either tax benefits or maximize, get as much source funds into the deal as possible. So a lot of times we're thinking like, hey, let's put a solar panel on an affordable housing project, and then we can claim the low-income housing tax credit, and we can claim the solar tax credit, and quote unquote double dipping on some of those costs. So the old rules is that you could double dip to an extent, but you actually had to reduce your eligible basis by that same 50% of the credit. So not only if you're claiming a solar tax credit, you're still getting that full credit. You're losing out a little bit on depreciation, and then you're losing out a little bit on eligible basis and low-income housing tax credits. It was still economically viable and still saw a lot of use, but it did limit, it did limit the benefit a little bit. But in this, under the IRA, in the new rules, you still lose a little bit of your depreciation expense, but this eligible basis reduction no longer applies. So the IRA has a specific carve out between the interplay between the low-income housing tax credit and the solar credit, and now you do not lose eligible basis for your solar tax credits.
Just a good. We have a question out here.
Oh, go for it.
Okay. So how close this goes back to the how close does the nexus have to be for fossil fuels? Would the presence of an engineering company, oil or gas production company matter, or does it have to be extraction specific?
That I do not. I'm not sure about the specifics. So,
it would all depend on the census tract, right? I mean,
I don't think that one is derived from a census tract. I think it's got a more calculation, but I have not done a further dive in, other than knowing is there. So unfortunately, I don't have extra insight into the actual specifics, and I don't want to talk specifics where I'm not correct on it.
Okay.
But yeah, so it's something that I would this would be kind of something I would research on a case-by-case basis as it came up, but not off the top of my head, unfortunately. All right, just trying to mentally think where we're at, where we're going. So with the 20% boost in the application that is done with the DOE, if you're going to claim the 20% boost, then there is a requirement that 50% of the savings are passed on to the tenants. And that is just from people who've gone through this, is really it's addressed both through the application process and then also once placement and service is met. And there's a lot of specifics, like a lot of specific rules, but I think what we're really seeing is like, and basically bottom line is some of these energy savings need to be passed on to the tenants. And a lot of times you're looking at something like utility bill savings or something like that that's passed on to the tenants. It doesn't have to be, you know, a monetary payment, like a reduction of utility bills can satisfy this 50% requirement. And I think this is tripping up some people, and I know some people that are going through the application process that are trying to do the math and seeing whether this provides a benefit or harm, or whether they're going through it or not. So I think that's something to consider, that for getting the 20% boost, you're gonna have to give up a little bit more of the financial benefits. So it's not just a straight 20% free money. There could be a, definitely like a cost component attached to it. So this, I believe this chart's from the DOE. It's not the world's greatest chart. The part that's the most applicable is honestly this little strip in the middle where it's talking about 2023 to 2033. Where we're looking at it kind of goes over the credits, the percentages, where the base credits are 30%, the domestic contents is a 10% boost, there's a 10% energy community boost, and there's a 20% qualified low-income residential boost. And then also talks about like what are the base credits for the 6% and et cetera, et cetera. So and one thing also to mention when we're talking about the fossil fuel stuff is there's a lot of the solar companies that are doing these pitches too are also like looking into the requirements and kind of know. And there's also a lot of energy kind of consultants that either help with the application process with the DOE that kind of would know a lot of like the more construction specific related items beyond the accounting, or I'm focusing on the accounting, compliance, economic benefits. And then there's also the energy consultant who is that engineer that's licensed to actually do these energy studies and certify that the projects, meet like some of these 45L requirements. So just trying to throw some extra guidance out there. Yeah, so that I think that covers the solar tax credit stuff that I wanted to really talk about. So this isn't a new concept with the solar tax credits. We have seen these paired already for multiple years. And we're starting to see like a lot of creative uses for these. So I think most of us classically think, oh, I'm solar panels, I'm going to put them on the roof, or I'm going to do, somehow attached to the building. Whereas I think a lot of movement now, especially in areas where there is more land available or there are bigger parking lots, like really kind of incorporating other types of concepts where you're looking into either carports or open space panels. So I think there's different ideas that can be creative. And this specifically say that the panels don't have to be attached to the building. It can be on like an adjacent land, as long as the panels are able to provide benefits to the tenants. And I guess also one thing to mention with the solar panels is in order for them to be LIHTC eligible basis, you still have to basically treat them, kind of have to follow a lot of the common space rules, like the providing, benefits to the tenants, they're not having to pay for it and stuff like that. And the project isn't, selling the energy and not passing it on to the tenants type situation. So you still have to meet your eligible basis rules if you want to do your double dipping. The next kind of big button topic out there is this 45L credit. which this credit has also been around for many years, and has also been on the brink of extinction and brought back to life multiple times. Is actually even like lapsed for a couple of years and then brought back to the living. So we've seen it in lots of different forms. We have seen it paired with affordable housing, LIHTC, in the past, but not very often. And as we get through this more, I think we'll definitely spend some time talking about why didn't we see it before and why are we seeing it now. So just some first of all, just like an overview of the 45L, and then we'll talk about kind of the pairing with LIHTC as we talk about changes between the old versus new rules on this too. So 45L is a residential energy efficiency tax credit. It is available for both single family and multifamily homes. And there's the specific energy requirements that have to be met. The credit amount now ranges from $500 to $5,000 per home/unit. And again, with all these tax credits, there's lots of different charts and boosts and things to use. So I'll try to focus on what we're seeing, kind of the most important ones. But I think a lot of these kind of requirements, I think we're mostly probably familiar with. So we got the Energy Star residential new requirement or new construction rules, the Energy Star multifamily new construction rules, and then also the Zero Energy Ready Home program. So, and I will say that now we're seeing activity in both the Energy Star and Zero Energy Ready Home program. So we're seeing the ranges between 5 and 5,000 for sure. And also with the 45L, there are opportunities to double dip or claim these credits and add them to the capital stack along with the solar tax credits, aka Section 48, in the 179D deduction, which I promised I would do a little bit of a talk at the end. As part, it used to only apply to buildings that were 3 stories or less, which was also a very, very limiting factor. But now the size requirement is no longer applicable for deals going forward. So it can now be paired on deals of any size. This credit is a little bit different. In order to certify that the project is eligible, the certification has to come from an IRS approved third-party advisor. So this person, as I mentioned, is there's kind of either brand as an energy consultant. They're typically engineers by trade, because the certification process that they go through isn't vouching your costs that are into it. It's really looking at are these energy efficiency rules of these different programs being met? So it has to be done in some kind of energy study. And just some guidance that I've been, other people have been sharing with me is that for best results, if this 45L credit is looking to be added to, to these deals, most consultants would always advise bringing them in before project completion, because a lot of these things that attribute to meeting these programs are more inside the guts in the building, where you're looking at different installations and windows and roofing and other types of heating, cooling systems and ducts and other construction requirements that I only pretend that I know. Definitely not my area, but that's to say, sometimes if bringing a consultant in after the deal's done can be sometimes problematic if they're not able to certify that these rules are being met. So just some a little bit of wisdom that people have been sharing with me. we didn't really talk about allocations of tax credits to partners, but now is a good time, especially for any developers who are out there, joining today that might want to talk about, well, what can these credits bring to the table? So, um, and I know I actually now remember I got some slides for the solar tax credit later talking about some of those new rules. So we'll touch on that. So we are used to our LIHTC and affordable, our low-income housing tax credits being allocated in accordance to our partnership ownership percentage. So, a very common deal structure of an affordable housing project is owned inside of a partnership, LLC, LP, etc. That's owned 99% by a federal tax credit investor and like a 1% general partner. And then, through, a certain period of time, the tax credits and all the losses are allocated in accordance with that 99-1% split. With various different exit options between, puts and calls and etc. That can occur at the end of the cycle to change those allocation percentages. And 45L is no different, where it typically follows your ownership percentage allocation. So also in LIHTC deals, we're used to doing credit pricing, where we're estimating how much tax credits we are generating, and then as we're looking to close an investor into the deal, we're running financial models. The investor has like a underwriting at a certain price per credit that they're willing to put their equity in exchange for those tax credits. So the same concepts can apply to the 45L credit, where at the beginning of the project you could say we're anticipating getting $2,500 for 100 100 units for $250,000 of tax credits, and that's going to be allocated, it's 99% to the investor, and we're going to pay 90 cents on the dollar, and we'll fund our equity based on these installments in the operating agreement. So it can function in exactly the same way, but there is an added option for 45L that can actually be specially allocated to the partners in the partnership, as long as it is written into the operating agreements prior to the allocation. And I think there might be a little contention out there. I think it's still always going to be dependent on an investor and council kind of approval on it, but I've seen it already occurring, being underwritten and actually occurred in live operating agreements that were that are supporting this allocation of bifurcating. So this bifurcation can be really cool and actually provide some more benefits. So it's if the investor is only willing to pay 90 cents on the dollar, but there is an owner through the developer side, whether it's some sort of other investor or principal owner of the development company, if those credits can be passed up and utilized and offsetting actual tax dollars at the top for dollar for dollar, then it might actually be more beneficial to forego quote unquote selling or getting an equity investment for those credits and passing them up through the GP side. So it's kind of an option. Also in cases where either investor isn't can't use them or isn't interested in providing additional equity for the credits, or is an extra option available for the 45L. And to clarify, this is not a solar tax credit option. It's only the renewable energy tax credit. So here's the chart. I imagine a lot of us have already seen some kind of version of this. There's three different buckets. There's rates for single family homes and manufactured homes, which those are set at $2,500 to $5,000. The only distinction between the dollar amounts here is the program, whether it's Energy Star or Zero Energy Ready Homes. And note that there is no prevailing wage requirement on this side. However, on the multifamily side, there is a prevailing wage requirement. So it's kind of the first thing to think about when you're doing the flow chart is for a multifamily deal, is the prevailing wage requirement being met for all of the work that goes into what's generating the 45L, which tends to be all of the construction, because you're touching a whole bunch of different components between heating, cooling, ventilation, insulation, roofing, etc. So are those prevailing wage requirements being met? Yes or no? If you're no, then you're between $500 to $1,000 per unit. If you're at yes, you're between $2,500 and $5,000. So I think what we're really seeing is most people looking at, applying it to deals where the prevailing wage requirements are being met to kind of get to that $2,500 boost. And I would say the overwhelming majority are aiming at that Energy Star prevailing wage $2,500 per unit, because there's a lot of different factors that can go into play on whether the Zero Energy Ready Homes provides enough financial benefits for justifying the increase of cost in exchange for increased tax credits. But I will say that we are definitely seeing Zero Energy Ready Homes being used, as well as the Energy Star. So this tax credit is different than our low-income housing tax credit that we've been using in the past, where the low-income housing tax credit, we claim that over 10 years, either a 4% or 9% credit of our cost of construction, and we split it up and claim it, over 10 years with a 15-year compliance period. Well, the 45L, this dollar per unit, is claimed in all in 1 year, in the year of placement in service, which is the same rule as the solar tax credits. So it can provide a very larger impact by not being split up and claimed over 10 years. So you don't get a degradation of economic benefits by having a time value of money concept layered in there. So getting back to the solar tax credit, so I mentioned, well, I guess this is more for other types of credits too, but so the 45L, we mentioned we can bifurcate. There's other kind of some beneficial rules that have been created for some of the solar tax credits and other energy credits. And they've created two other options. One of them is called this elective pay or direct payment option. And then the other one is a transferability option. I was a little sad after digging in a little bit into the direct pay option, because at first, we hear, oh, this is really aimed at governmental and not-for-profits, and tribal governments, and other types of not-for-profit entities. And we're like, oh, well, we're used to those type of entities. Some of us on this call are very likely in, with either not-for-profit developer or stakeholder, et cetera, that are involved in this. However, as we dig deeper into this, the really crux of it and where we start our flowchart decision is, is the entity an applicable entity? And what that means is this government agency or nonprofit agency, do they actually own directly the energy property that's generating the credit? And we say directly because an ownership of a partnership interest in a partnership that owns the solar credit does not provide that direct ownership to be. So unfortunately, this direct pay option isn't available to a partnership that has either government or not-for-profit ownership. So that's why I said it made me a little bit sad. But it's still a huge benefit to, so kind of the idea overall, the IRS, was understanding that there's very little, incentive for a government or a nonprofit agency to actually construct their own solar energy or other type of energy property, because the financial benefits weren't really useful to them. The tax credit wasn't useful, wasn't as useful to them. So they allowed an option for them to do a direct pay, which essentially is kind of like a tax refund for the credit amount instead of getting no benefit for it. So it's still a really cool idea, just unfortunately doesn't really pair too well with a low-income housing tax credit project. But one area that is very, very useful is the solar tax credit and these transferability rules. So I talked a little bit about the low-income housing tax credit, how it's typically allocated 99% to an investor partner inside of this partnership. And those, there's very little ways to get around these rules, because it's written into the law that, however depreciation is being allocated, that is how the tax credits are going to be allocated, bottom line. So that pretty much turns out, that the partner is going to need to get 99%. The investment tax credit generally followed ownership percentage as well. But I guess, like me being a tax accountant, it's a little bit technically nuanced different. So it typically followed ownership percentage, but the real underlying thing we would look at is how are profits being allocated and what's the profit allocation percentage. And then that's how we would allocate it. It just so happens that our loss allocation and our profit allocations are typically the same. So that's why we would typically think of solar tax credits being allocated in the same percentage, or straight to the investor. So sometimes the partnership entity, for various reasons, either to get better pricing or to provide more benefits, may actually want to sell the tax credits instead of allocating them up through the ownership structure to the tax credit investor. So now there is this transferability option. So I like to think about it kind of in, if anyone has worked with certain types of state tax credits, mostly falls under the like the historic tax credit rules, like the state historic credits we see in a lot of different states, where there's a tax credit certificate that's issued, and the recipient of that certificate can sell the credit to an outside individual, to any eligible individual that they want to, that's not passed up through ownership structure. So this concept isn't a new concept, but it's being applied to a federal tax credit that we really haven't seen before, because most federal tax credits being awarded to a partnership entity, since most partnerships, LLCs, entities being taxed as partnerships, don't owe taxes, then under the tax rules, they typically allocate all of these credits and other tax attributes to their partners, rather than offsetting taxes or owing taxes. So this is, again, not a new concept, but it's being applied in a very new way. And so as part of this, also earlier this year, the IRS issued some kind of further guidance on what those rules look like. So definitely something to pay very much attention to. If this is an interest to transfer the credits outside the partnership instead of allocating them, then definitely, I would pay attention to the rules, consult with, other, tax accounts to kind of like walk through the rules. But the transfer has to be paid for in cash. and there's a specific timeline. It has to be paid by the due date of the partnership tax return. So for a solar tax credit that is earned in 2023, it needs to be sold in cash by March 15th of 2024. So there is a very specific timeline for doing so. And then if not sold, it just defaults to being a allocated credit to the partners. I haven't seen it yet, but the IRS said that there's going to be some sort of like registration or, way to notify the service of when these credits are being transferred. I think like some way to log these sales, but I guess further information is going to be provided as we get closer. As we get closer to tax season. I guess all the accounts on the call are cringing at that word, but we're getting close. We're getting there. So mentioned, yeah, so we got to register with the IRS. You got to do the sale in cash. The credits can only be transferred once. And what this really means is it kind of actually limits the ability for syndication in this realm, whereby you would have some kind of fund entity out there that would exist solely to, buy these transferred credits from affordable housing building and then locate their own sellers and then sell it, basically broker a transaction through a sale. So you can still have a fund that buys these, but then that fund can't just sell it can't do a direct transfer that way. It would have to then be allocated to its partner. So you can only do this transferability once. And then if it's bought by like another pass-through entity, then it's going to be allocated further up the line, kind of with the old rules.
Tim, I'm going to interrupt you again because I think we may have slipped past this topic. I just got a question from Megan for 45L single family home ownership, ZERH development, direct pay to a nonprofit developer. Do you have a sense of any minimum SFR unit thresholds for feasibility?
I don't know what that is. So I guess I have to say I probably I don't know. I think that's more getting into more like construction related expertise that I do not have. And I haven't heard any talk over specific rules on that to give anecdotal talks.
Sure. Again, if you have any more clarification on that question, feel free to throw it in the chat and we'll continue. Thanks, Tim.
Yes. Yeah, I mean, this is all good stuff. Love the question. Sorry that like this, just like all things we deal with, this broaches on a lot of practice areas between engineers, contractors and accountants and counsel as well. So yeah, I try to do my best to keep my ears open and stuff like that. So I will keep the questions flying and I'll see if I can see if I've heard of it or kind of know an answer. So
Hey, Tim, we got another question. If the 48 credits in a LIHTC project are transferred to a separate investor, does the LIHTC project cash flow still have to follow the ownership interest, 99% the LIHTC investor during the 5-year recapture period?
Yeah, so let me think about this for 1 second before I do my ruling on it. I'm trying to keep this straight in my head. So if we do the transfer, so the compliance is still resting with the project. So you would have to follow the same kind of cash flow rules that we've typically seen. So, and what these cash flow rules are what we're talking about. We mentioned that solar tax credits have to be allocated in accordance with profit percentage. Profit percentage can be a lot of different things. Mostly what we think about is written in operating agreement saying our profits are going to be allocated as such, this percentage to this partner and this percentage to this partner. Where it gets really tricky when we're dealing with tax law is we have to look at more than just the black and white of what's written as our profit percentage. We really have to look at current and future expected kind of economic benefits and cash flow. So what you would normally see in a solar tax credit deal that can be off-putting is that during the 5-year compliance period, the investor is pretty much going to, require that cash flow distributions would be done in accordance with the actual ownership percentage and not, extra percentage to the developer or to one specific partner. And that's because distributions paid that are not in accordance with ownership percentages can actually be deemed to be profit percentages. But yeah, so the compliance of the solar panel still resides with the owner, but you can still do yeah. So unfortunately, that's still going to be a component, whether it's transferred or not. That's a very great question. So with the solar credits, there's a little bit of flexibility. You don't have to, it's not an all or nothing deal. You can actually split up, not split up, but you can sell parts of the credit, meaning that you can sell half of the credit, 80% of the credit, however much you want to. So you can do like a split between transferability and then allocation up to the investor side. The only rule is that you can't allocate the layers separately. Like you can't allocate a 30% base credit to one partner and then not sell, allocate the 20% boost different. Like each kind of allocation and transferability is deemed to be either allocating or transferring each little cross section of all of the different layers of the boosts, the different boosts. So with the transfer, there was lots of different credits that were written to be eligible for the transfer. It's kind of turned into like a laundry list, and then it turns into like a hunt of what's not on here. And what you'll see is not on here, as we talked about, is the 45L is not on there. So unfortunately, we can't do the elective pay or transferability options, but we can. You can do that kind of bifurcation idea that I mentioned with the 45L piece. So we're seeing lots of these being combined in lots of different ways. So before, we only saw 45L in very specific deals that were 3 stories or less, and were like a 9% LIHTC that had excess eligible basis that could withstand an eligible basis reduction and still get the 45L credits. So that was kind of a specific subset that we saw before. Whereas now there is no eligible basis component. So the 45L is really, being an attractive option for a lot of people. And then the 48 solar credit was already being done before, but now it's even more beneficial and provides more economic benefits to the residential buildings. And then these are interplaying very nicely with each other. There was some recent guidance the IRS just issued and proposed regulations that kind of talked about interplay. And at first, I had like a mini scare because it said, the solar credit, can't be, like you essentially can't double dip with other credits. But then as you look into it, there's a specific carve out for section 42, and saying that you can still qualify for both of those with the same costs. The only one I'm still kind of putting thought to and bouncing some ideas off is it doesn't carve out any interplay between 45L and the solar credit. So I would be remiss if I didn't throw out there that we're trying to analyze and think about whether there is any issues. But at this point, I don't think we're looking at the same cost for qualifying as 45L and the solar credit. Is kind of my initial thought. So I think we're probably fine. But if there's other kind of tax credits involved in the deal where there's a solar credit, if those costs are driving two different tax credits, then there's potential limitations in the applicability of those tax credits. So yeah, so with that, I think this kind of what I was planning on kind of going over and going through with everyone. I know it's very heavily tax related. It's got a lot of different charts and different concepts. But we'll provide the slides, and definitely happy to take questions or talk about any, like if we want to go over any ideas again and kind of talk further about them. Definitely happy to go where needed.
Hey, Tim, did you want to talk about the 179D real quick?
Yes, I do. So the 179D, so we still will see this in very small subsections of deals. But the problem is the eligible basis reduction component was not removed from the 179D deduction. So no matter how we structure it or who's claiming the 179D, then there is an eligible basis reduction. So I don't think I've ever actually worked on a 179D deal where it panned out. It's typically also more expensive, provides a little bit less benefit historically, where the cost per unit for getting that in the certification is much more in depth than the 45L wasn't quite worth it. But still definitely a thing. But the energy consultant or engineer, I said that works for Reuben Brown. He's also 179D certifier, and he's saying like, other industries are jumping on the 179D, like our industry is jumping on the 45L. But we're still seeing very limited activity because there still is unfortunately, that eligible basis reduction component to it. And also that's a deduction. That's really just an acceleration of depreciation deduction and not a tax credit, like an extra tax credit. So the actual economic benefits is less than would be provided by a tax credit. Thanks, Jeff. I was thinking about that as I was wrapping up and then forgot to get to it. So thank you.
Okay, well, thanks, Tim. We went through a lot there. Anybody, on the webinar, if you have any other questions, you can look at our website for our email addresses. We're out there, or you can just get a hold of us through Housing Colorado and Philip. Philip, did you want to add anything before we sign off?
No, I just want to give a little bit of a pause in case people are frantically typing questions, and allow that to happen. But I really do appreciate Jeff and Tim, your knowledge. There's so much more to go through. I would encourage you to check in with Reuben Brown, Jeff, and Tim specifically to ask specific questions. I have always found both to be very open to chatting, so reach out. There is a question here: will Housing Colorado make the presentation slides available? Yes. The answer to that, I will send the presentation slides along with a link to the recording to everybody who is registered. And of course, feel free to share that. This is a free webinar, so there's no gatekeeping on that right now. And I also have requests for Tim's email address. Tim, are you able to share that, or would you? We can also look that up on Ruben Brown's websites.
Oh, yeah, I can just type it in the chat too.
That'd be awesome. Thank you.
It's very complicated.
Tim Dot Anderson. I wouldn't.
Yeah.
I wouldn't have known. All right. I have to. I'd say I did not create the event in our website where people registered, and you were listed as Timmy Anderson on there. I don't know if that was intentional or just
So
playing a joke on you.
there's a long story behind it, but yeah, so I actually go by Timmy. That's my preferred name, but I will answer to Tim. And my email a long time ago got set up that way, and I never said anything. And now at this point, I've got like thousands of contacts, so I don't want to change it. So
Well, there we go. So you have some options if you reach out to me.
yes.
Uh,
Oh, it didn't go out in the chat. It's
I
Tim.
see why. I can send that out again. It went
Yeah.
out to hosts and panelists, so
Yeah.
I can
Oh,
see it, but that doesn't help the
oh,
rest
I
of you.
can
I got it. There you
Okay.
go.
Thank you.
Thank you, Chafee, somebody. I can't see who that is. But cool. Yeah, we're good. So thank you again. Watch for some of the additional Housing Colorado content that's coming out. I think my assumption is that people who are interested in these tax credit conversations are also going to be interested in some of the other things that we have going on, including the discussion, the site tour around Walden 35, which is an all-electric project. So they use some of these tax credits and struggled with certain ones and were successful in other ones. So that's a definite addition to what you learned today. And again, check and watch our Housing Colorado website for the other events that I mentioned. If you're not on our mailing list, you can reach out to me, philip@housingcolorado.com, and I will forward your information to the right people to get you added to our mailing list. We've got our newsletter coming out every month, comes out next week, and it's going to have a lot of updated event information. So thank you so much, Tim and Jeff. Thank you for our participants, and I will let you all go. I do not like when people tell me that I'm giving you 25 minutes back in your day because we've already stolen an hour and 35 from it. But thank you for the time that you've given us, and you all have a great day and a happy holiday season.
Thank you so
Thank you.
much.
Bye.
Bye bye, everyone.